If I were to create a tax-proof retirement income plan today, this is exactly how I would do it, starting at 55. The difference between a good retirement and a great one isn't about how much you've saved. It's about how much you get to keep after taxes. And if you have most of your money locked up in pre-tax accounts like 401ks and IRAs, you're sitting on a tax issue that's going to surprise you when you hit Medicare age and RMDs. In today's video, I'm going to walk you through a step-by-step framework for building a tax-smart income plan starting at age 55 that can literally save you hundreds of thousands of dollars over your lifetime. We'll cover the 3 tax buckets you need to understand, why most advisors get withdrawal sequencing completely wrong, and a real example of how one couple converted $500,000 to Roth over 5 years and is projected to save over $200,000 in lifetime taxes. Before we dive into the strategies, you need to understand the foundation. All your retirement money falls into one of 3 tax buckets, and each bucket is taxed completely differently. First, you have pre-tax accounts. These are your 401ks, traditional IRAs, and 403bs. You get a tax deduction when you put the money in, but every dollar you take out is taxed as ordinary income. When you turn 73 or 75, depending on your birth year, the IRS forces you to start taking required minimum distributions, or RMDs, whether you need the money or not. Second, you have Roth accounts, Roth 401ks and Roth IRAs. You didn't get a tax deduction when you contributed, but the growth is completely tax-free and you never have to take required distributions from a Roth IRA during your lifetime. Third, you have after-tax or taxable brokerage accounts. These are your regular investment accounts. You already paid taxes on the money you put in, so when you withdraw, you only pay taxes on the growth, typically at favorable long-term capital gains rates, which can be 0%, 15%, or 20%, depending on your income, much lower than the ordinary income tax rate. Here's why this matters. Most people retiring at 55 have the vast majority of their wealth in that first bucket, pre-tax accounts, and that creates a massive problem down the road. Let's walk through a common early retirement scenario. You're 55 years old with $2 million in your 401k, another $300,000 in a taxable brokerage account, and you're ready to retire. Conventional wisdom says you should start pulling from your 401k right away because that's where most of your money is. But that's actually the wrong approach. The smarter strategy is to structure your withdrawals intentionally and in the right order. Here's how it works. From age 55 until you claim Social Security, you want to prioritize taxable brokerage accounts, Roth contributions, and cash savings as your income sources. Why? Because brokerage withdrawals are taxed as long-term capital gains rates, usually much lower than ordinary income. That means you keep more, sell fewer shares, and give your tax-deferred accounts time to grow. Plus, you're reducing the pressure on your portfolio during a period when sequence of returns risk is at its peak. Then, from age 60 to 65, you gradually shift your income to IRA and 401k withdrawals, while simultaneously starting Roth conversions, ideally up to the top of the 12% or 22% bracket, depending on your plan. This is also when you begin planning around IRMAA brackets to manage future Medicare costs. The goal here is twofold: maximize spending in your early active retirement years and preserve shares and reduce future tax burdens. But there's one powerful tool most early retirees don't know about: the rule of 55. If you separate from service in or after the year you turn 55, you can withdraw penalty-free from your current employer's 401k or 403b. That's right, no 10% early withdrawal penalty. This doesn't apply to IRAs or plans from previous jobs, but if you're retiring from your current employer, it gives you critical flexibility to access retirement funds earlier without triggering extra taxes or penalties. So, whether you're drawing from your brokerage first or using the rule of 55 for penalty-free access, the key is having a sequence plan, not just a pile of money. The right income structure can buy you time, lower your lifetime tax bill, and create more freedom in those go-go years of retirement. Now, here's where the real magic happens. Between age 60 and when your RMDs start, at 73 or 75, you have what I call the tax bracket arbitrage opportunity. Your income is low because you're no longer working. You're not taking Social Security yet. You're living off your brokerage account IRAs, which generate minimal taxable income. This is the perfect time to do Roth conversions. Let me explain what that means. You're intentionally moving money from your traditional IRA to your Roth IRA. Yes, you pay taxes on the amount you convert that year. But you're paying taxes at today's lower rates, maybe the 12% or 22% federal bracket, instead of the 24%, 32%, or even 35% bracket you'll be forced into when RMDs kick in. Let me give you a real example. This is a hypothetical scenario for illustration purposes. Imagine a couple at age 62 with $2.2 million in their IRA. If they do nothing and wait until age 73, their RMDs could push their taxable income to over $220,000 per year. They'd be paying some taxes in the 24% bracket, possibly jumping to 32% as their balance grows in their 80s. But if they convert $100,000 per year for 5 years starting at age 62, staying within the 22% bracket, they're paying 22% now instead of 24% or higher later. That 10-point difference on $500,000 is a $50,000 swing. Factor in compounding, and the savings can exceed $200,000 over their lifetime. Here's something critical that most people overlook. Bad or negative returns in retirement don't ruin your plan. Being forced to sell during a downturn does. This is called sequence of returns risk. You need to build a stable war chest of 4 to 5 years of income, held in cash or cash-like investments. Let's say you need $80,000 per year from your portfolio. You should have $320,000 to $400,000 in highly liquid, stable assets, high-yield savings accounts, money market funds, or short-term bonds. Why? Because when the market drops 30%, as it did in March of 2020, you're not forced to sell your long-term investments at a loss. You have that cushion. You can let your growth investments recover while drawing from your stable bucket. This one strategy alone can be the difference between a portfolio that lasts 30 years and one that runs dry in 20. Let's talk about Social Security. Conventional wisdom says delay until age 70 to maximize your benefit. And for many people, that's correct. But for early retirees doing Roth conversions, the decision is more nuanced. If you claim Social Security at age 62, you accept a 30% reduction compared to your full retirement age benefit. But here's what many people miss. By taking Social Security earlier, you reduce the amount you need to withdraw from your portfolio during market downturns. This can actually preserve more wealth over time than waiting until 70, especially in a volatile market. The key is running the numbers for your specific situation. If you're doing aggressive Roth conversions in your 60s, delaying Social Security to 70 gives you more years to convert at lower tax brackets. If you're not doing conversions, or you need the guaranteed income earlier, claiming at 62 or 67 might make more sense. When one spouse passes away, the surviving spouse gets hit with what's called the widow's penalty or the survivor's tax trap. Here's what happens. When you're both alive, you file taxes as married filing jointly. The tax brackets are roughly double the single filer brackets. But when one spouse dies, the survivor spouse files as single, and those brackets get cut in half. Let's say you're both living on $140,000 of income per year. As a married couple, your effective tax rate might be 11% to 12% when one spouse passes. The survivor still has roughly the same income. Social Security gets reduced to the higher earner's benefit, but RMDs continue. But now they're filing as single. Their effective tax rate can jump to 16% or higher. The solution? Roth conversions now while you're both alive and in lower married filing jointly brackets. Convert at 22% today to avoid the survivor paying 24 or 32% later. This is estate planning and tax planning combined. Look, building a tax-proof retirement income plan isn't about timing the market or picking the perfect investments. It's about having a comprehensive strategy that coordinates your income sources, minimizes your tax burden, and protects you from the surprises that derail most people's retirement. If you want help creating a customized plan for your specific situation, visit the link in the description below to schedule a fit visit with our team. We'll walk through your numbers and show you exactly what's possible. Thanks for watching.